One thing you know is that you think we should be buying the pound.
Yeah, I think sterling at these levels, you know, this is for the brave and for the medium term, but I think it's now discounting some pretty extreme outcomes. So I think there's a lot of noise around sterling. There were a lot of people saying it was overvalued going into this. I don't really think that's true. I mean, it very much depends which cross rate. It was cheap against the dollar going in pre-Brexit. It's super cheap against the dollar at these levels, if you look at it in an inflation-adjusted basis. But I also think there's a lot of noise around the current account. That's a huge misunderstanding. The trade deficit in the UK is only 2.5% of GDP. The rest of it is net income, which is largely accounting treatment. So if profits of overseas investment in the UK is high and, say, the European economy is depressed, the current account widens as a matter of accounting treatment. That's not even an FX flow. Nothing actually happens in the foreign exchange market. Also, that current account should turn around very, very rapidly for precisely this reason. So I think, yeah, that sterling on a fundamental basis into the medium term is offering you some value. You know, there's a lot of sense in allowing it to stabilize. It may be stabilizing now. I think there's going to be a reassessment already of the interest rate outlook. So I wouldn't be surprising. The probability of the Bank of England, certainly on hold, may even raise rates on a 12-month view, is not unreasonable. So I think sentiment and attitude towards sterling, the risk-reward, has fundamentally shifted.
Eric, what about the fact that you're saying don't get into UK gilts, though? We saw a sell-off that sparked on Tuesday. Is that gilt curve going to keep on still steepening when it comes to the United Kingdom? Is inflation the main driver of that?
Well, this is one of the fascinating sort of unintended consequences of Brexit. I mean, some of this, you know, most countries, developed countries in the world close to the zero bound, would love to have a lot of these dynamics, which is that you've got a much, much weaker exchange rate, which on balance is a stimulus to the economy, and broadly, potentially a higher rate of inflation, which allows interest rates to go up eventually. So that dimension of it is something that's positive. I mean, obviously, and I think one thing that we need to look to in the GDP data is I think the components of the UK economy could do very, very different things. So clearly the area that could be weakest, and we haven't really seen good data on this yet, is what happens to corporate investment spending. So I don't want to sound complacent. I think there are, you know, the way I think about Brexit is you know, this is a 2-hour movie and we've just seen the first 10 minutes. It's way, way too early to draw conclusions. But if we roughly assume that, you know, people in the end are going to be pretty sensible, which seems a reasonable supposition from my perspective, I think then, you know, you can see a scenario where into the medium term we see sterling trading materially higher than it is today, certainly against the dollar and the euro.
Sensible politicians. I admire your optimism.
I sound very naive.
We're expecting a 0.3 today. Do we avoid recession? Is it just recession deferred? Kind of give me a sense very quickly.
Yeah, I think that the key issue is look at what happens to the investment component. Yeah, so I think the final demand, consumer spending, is going to be pretty stable, if not strong, in the UK. But the wild card here is investment. That's the bit to look at in the GDP data. So are corporates materially contracting investment spending?
Great to see you this morning. Thank you very much indeed for sharing so much of your time with us. Eric Lonergan joining us from M&G Investments.